What we're going to do in this video, I'm going to talk about the cost of long-term care. I'm going to talk about the traditional ways of covering the cost, why some of them don't work. We're going to talk about pluses and minuses you can see up there on your screen. Traditional long-term care insurance. Newly, over the last few years, life insurance with living benefits. They're going to twist all the time. And then annuities with enhanced income, which can help defray the cost of long-term care. And most importantly, along the way, we're going to be talking about how to think clearly. How to think clearly. What ends up happening is people say, okay, I didn't really get what I was trying to do. Most of the time, it's been my observation that what happened is right from the jump, right from the very beginning, what was trying to be accomplished, the objective, wasn't clearly defined. So then you try to attach a solution to a poorly defined objective. Somebody's going to be disappointed. Someone's going to be disappointed. Let's go ahead. So this is, like I said, the steps for any financial topic. And the reason is that once you decide on what you're trying to accomplish, you can then define what resources you have to allocate to that. Right? Because then what ends up happening is then you can properly fit what you can afford to what something costs. Because only when you do A and B can you then find out whether or not the market, because I don't control the price. I don't, right? I always do my best to try to get the best price, the best benefits for the best price. That is clear. That's my fiduciary responsibility. But really then A and B and C must match together. They've got to match all together. And here on the right-hand side of your screen, you can see what happens is somebody comes to me after the fact and something has gone wrong. And what has gone wrong? Invariably, almost all the time, something here has occurred, which is you needed to go in that order. You cannot skip around, skip steps, go from A to C, or then start with C, because what ends up happening is someone out there, I promise you, has already gone to point C and they said, okay, this is the price, forget it, I'm out. Doesn't work for me. Maybe you haven't looked at everything else, right? Maybe you haven't thought about all the resources. And what happens is you could have thrown it away even though you knew the topic was vital, okay? If you do it correctly, however, we can get to at least a solution, or you can decide, okay, now I decided I can't follow this path. It's time to move on. It doesn't matter to me, candidly. It matters to me that you got to the conclusion that you're comfortable with, not that you come to the conclusion that just costs you money. That ultimately will not work for me, because why? You're not happy. You blame me. I'm not happy as a result. It's much better than to say, like, Jay, we flipped over the rocks. Didn't work. That's an outcome that I can accept. Let's just keep going. So like I said, long-term care, the world's worth topic. It really is. You don't want to talk it to yourself. You don't want to talk about it with your spouse, your children. Forget your extended family. These are just not fun topics. And you're not alone. As a nation, we don't have a national strategy, period, right? We don't have a statewide strategy. In other words, in every state, do they have a strategy? No, because if a state did, everybody would move to that state. We don't have a strategy. Unfortunately, the options that we do have today are quite limited. They're there up on your screen, right? Medicaid, Veterans Administration. Now, these two are available. I'm not going to say they're not available. They are available, okay? But what ends up happening is you need to have a limited amount of resources, You needed to have spent your assets down to a particular level so that you can qualify for coverage under Medicaid. The same type of measurement, I'm not saying the absolute amounts, also must exist for Veterans Administration. That's not to say that they're not valuable. They are. But what I'm saying is you must have to push down your asset value, your savings, your belongings to certain levels in order to qualify for Medicaid or Veterans Administration benefits. Last thing, I'm just going to say it, quite bluntly, self-insurance probably doesn't work. And the reason is financial markets cannot replicate the payout required at the time that you need, right? Because this kind of is relying on a combination of you require extra money immediately because you require long-term care. Are markets cooperating right at that moment? It's not only have to be cooperating, they have to be cooperating right at that moment, at the time that you need most. And here you can see it, right? This graph basically shows you the problem that the long-term care solution, the financial cost is so big that this green line here all of a sudden kinks down to the red line. And you can see the text there on the left. Why didn't I put a household net worth number? Because reality is this should just be 100%. It does not really matter who you are, right? Because the average cost of long-term care, and I'm going to give you the link, it's at the bottom of this video, based on a survey off of last year's costs, off of 2018 costs. So what you have is basically $100,000 a year is your national average, basically. And I'm cuffing it. You'll be able to see because it gives a state by state, readout. So basically what that basically tells you is that every household is affected for all intents and purposes. I'm not talking about the top half of 1%. Okay. So if anything, what I don't get to show on this graph is a thing of time. Because this red line down on your screen, long-term healthcare, long-term costs, and service and supports, these are the two that can damage your household net worth most rapidly. Is you don't know how much it's going to cost, and you don't know how long it's going to last. And these two when you combine them, lead to the steepness of the drop of household net worth. Now, is there a way, right? You could see it, which is we saw the down. We're trying to look for something which can offset it. And this blue line here is that instrument. And you can see it. It goes flat and then it goes sharply up at the time that you need. Right? And this is what health insurance does. Health insurance is exactly this. This is the payout, which also happens to be the payout for a call option from financial markets, call and put options. So I'm going to swerve here. Looks like a duck, graphs like a duck. Guess what? It's a duck. Insurance is an option. That's the put call diagram. Insurance has the same diagram. Insurance is an option, period. Okay, anyway. What my point is your financial portfolio, 401k, IRA, 403b, TSP, doesn't matter which one you look at. You don't have this graph payout structure. You don't, right? It doesn't have this kinked line like this hockey stick. Right? Your financial markets portfolio cannot do this. Anyone represents that this is what your portfolio payout looks like in your retirement savings. Either you're taking risks that you don't know, meaning you've got a bunch of call options, right? Option type payouts. And if they're saying, no, this is what your portfolio will look like, no, just no. So back to what you're trying to accomplish. And it's not that easy, right? Because you're trying to accomplish what? So let's say your household net worth is 100, whatever 100% is. Because now you're going to try to say, okay, am I trying to protect all 100? Am I trying to protect 50, 70, 90? You need to think through this, because that tells me how much money you have to prepare can be used towards their protection. In other words, you can see it here, this minus 200 on this graph. This minus 200 is just, it could be any number. It's a matter of scale. I'm not here to determine how much you should pay. That's for you to determine, right? I'm trying to show you the angle of this payout for different products. That's what today is about. Last is, remember, you're paying this minus 200 in order to avoid paying Murphy's Law. And by Murphy's Law, people who don't know it, and when it rains, it pours, and it does so at the worst possible moment, right? Because I can always fix one single topic, right? Can you fix your bond portfolio? Yes, you can buy a put option, a single option against that portfolio. Can you do it today? The answer is yes. Does it cost you money? The answer is yes. But can you identify the solution? Yes, you can. The one that hurts you is not when a single thing goes, it's when a combination of stuff goes wrong. Meaning, your household portfolio declines and you simultaneously get sick. That one, right? This one is the one that punishes you. Because what happens? You liquidate your holdings at the low. That's like being a forced seller, whatever you want to call it. That's Murphy's Law right there. Okay? So if you're trying to rely on the fact that your household assets will be at the high at the very time that you get a long-term care bill, if that happens to occur, that's called luck. That's called luck. This, however, has a known cost and a known payout at exactly the time that you require. And that's the point of insurance. Too often what we have is this idea that I bought insurance, I didn't get anything from it. Yeah, that's not actually what the point of what you're trying to accomplish was. So right away, people got the wrong judgment of what they're trying to actually do. They have the wrong expectation, and therefore they start saying they're dissatisfied. That's when you have the idea of, I didn't like doing this or going into this exercise because right from the beginning, it was poorly defined. Right from the beginning. And we know who's to blame at that point. I am. Of course I am. Right? Meaning that, and it is true that it is my fault at that point, in that instance, if I did not clarify this step first. Before we continue on, this is the step that needs to be done well. Let's continue to motor on. Okay, so I told you that there were going to be steps. What can be done to defray the cost of this $100,000? Well, stop number one is insurance, a traditional long-term care insurance. And I'm not going to mince words. It's been difficult. There have been lots of headlines. There have been a lot of sellers, and now there are just a few remaining. It doesn't have a positive history. Why? I'm just going to be blunt. The long-term care insurance carriers, they screwed up. They tried to fit a square peg in a round hole, or however the saying goes. And the assumptions used on long-term care insurance, they didn't work out. No one canceled, right? No one canceled. And once people kept claiming, because of the fact that you could stay in a nursing home for multiple years, they kept collecting the X dollars a day for the maximum amount. And finally, long insurance carriers depend on the reinvestment of your premium dollars on interest rate markets. Well, The 10-year note is 0.6% today. What could they possibly make from your premiums? So they got the worst combination of these worlds. You can see here on your left, they got hit by all of these at the same time. So what happened? All the sellers rushed in to play with the shiny new toy. These things hit. The ones that were not committed stopped selling. Okay. And you can see it. Genworth, very large market share. Reality is the equity value of this company is basically zero. It's been trying to sell itself to a Chinese company for the better part of what, 2-3 years? So it has been a tough haul. That said, today, that market has stabilized, meaning while the number of sellers is fewer, no question, the fact of the matter is that sellers have better control of the math. And those sellers have knowledge of health insurance for the most part. So as a result, what you have is the fakers have left, right? People who, the carriers that wanted to play with the shiny new toy, those participants have left. What remain have been more carriers who are more committed to the business. That's not to say that everything is all, peachy keen. Challenges persist. Here are just a few. Number one, underwriting is still going to be a challenge. You have to be accepted by their underwriting standards because of the fact that the sellers are not rushing in. Underwriting is more difficult. Don't think it got easier in an age of COVID-19. The second point there is that standardized language doesn't exist in long-term care insurance. Well, activities of daily living, that is true. But from there, it becomes less comparable from carrier to carrier on when you get the payout. There are lots of little dip switches. Elimination period, daily maximum, daily minimum, maximum benefit amount. The different carriers are applying these terms. Non-forfeiture. In other words, they're playing with these terms in a way that differs from carrier 1 to carrier 2, to carrier 3, to carrier 4. The problem with that is that affects how much benefit you get and when. The third is that the premiums can increase time over here, right? The carriers, basically what happens is, let's say that they're inundated with claims, overwhelmed with claims, and the premiums don't cover the claims any longer. Can the carriers apply for rate increases with the state? The answer to that is yes. The answer to that is yes. They'll have to prove it, but can they do it? The answer is yes. The flip side, of course, to all of this is that for those persons who have had long-term care insurance and have had to actually get the claims, the payout is enormous, which still makes it a viable path for some. In other words, you can see it here. See this graph of this blue line? This is the steepest. If you require long-term care, actually, long-term care insurance gives you the steepest blue line. There's no getting around that. There you go. Which is this minus 200 is the money that you pay out on premium. That's the biggest. That said, this blue line here, the angle, the hockey stick portion of it, it's the sharpest. It's the sharpest. There's your bottom line on long-term care insurance as it currently stands. Hybrid life insurance. It's also, life insurance with living benefits. This market is new over the past 3 to 4 years, I would say. If there's one seller, there are 20. all with different variations. It does work. It does work, right? Because the reality is that the sellers in a highly competitive world know that there's obvious demand. They know that there's no strategy. The stuff that I led this video with, we have no national strategy. They know this. They know that there are more than 60 million people on Medicare right in that age division. So how it works, which is there, on your left, is that you can pull forward your life insurance benefits, receive them earlier if 2 ADLs, and that's activities of daily living, cannot be performed. That's got to be documented. The doctor has to be able to write it with and sign some kind of document that states this. And if your benefits aren't used, then your remaining life insurance benefit can go to your beneficiary. Lastly, on here is that for the most part, your premiums don't change along the way. Now, there can be an exception to that, and we'll get to that. But generally speaking, that you can have it so that your life insurance premium does not change, which obviously fixes one of the issues with traditional long-term care insurance. Now, this isn't exactly long-term care insurance, and this is very important. It is a distinction. It cannot be marketed to you in this way. In other words, when I describe it to clients, this is life insurance first with living benefits. That said, the math of money is excellent. The premiums are notably lower, and there are all sorts of twists. Like I said, if there are one seller, there are 20. And there are just some of the examples. Universal life, index universal life. With lifetime, there's life insurance that with lifetime guarantees. All of these are possible. And most recently, we see term life insurance with living benefits coming into existence. So the market is robust. Nevertheless, extreme caution is still required with everything. But here, because I said that there are 20 sellers, you need to understand that the differences inside the policies are, again, enormous. Like I said, universal life, index universal life, guaranteed universal life. These are just 3 of them. And as I said, term life. And every carrier has its own variation. They're using the terminology, they're deploying the terminology, and therefore the premiums differently. And that's why I lead to the panel that you see on the right-hand side, which is that the lowest premium, of course, we understand this, right? That cheaper is better. I get it. Of course it is. But it's not the only factor here. And in certain instances, depending on the type, on indexed universal life specifically, if for financial markets did not work out, you could receive a nasty surprise, meaning the monies you paid may not be able to continue your life insurance. And when do you get this notice? Back to Murphy's Law, the worst possible moment. So the trade-off is there, and there's no shortcut to it. And on this, I can tell you that on an a la carte basis for certain persons, they come to me and say, Jay, I have this issue. I think it fits. I want to explore it. One-time fee to turn over all the rocks with you. Here are a couple of the things when we're talking about those 3 big groups. Universal life. It may not be guaranteed to last forever. So the way that life insurance, universal life is priced, and I'm going to have an entirely different video on universal life specifically, is that they have assumed a particular financial market's performance. And based on that assumption, then they calculate your premium. Today, for example, what has happened? This used to happen 15 years ago, and today we fast forward warp speed to today. What we have people today with problems because the assumptions, remember I told you there were assumptions going in, those assumptions haven't played out. Interest rates are notably lower. than where people may have presumed. And this has become a real problem because the cash value inside the policy has run out. So you get the notice. Your policy will expire if you don't pay a new premium, and this is your new premium. This is happening today. Every day, I promise you. The problem here is that, and this goes back to define what you are trying to do, because this could have been taken care of up front, because there is such a thing as, like I said, guaranteed universal life, which never expires. In other words, it says even if financial markets don't cooperate, then guaranteed universal life adds this extra feature to say, okay, even in that instance, it doesn't expire. What do you expect for this extra feature? Extra cost, higher premium, right? And in addition to that, you can't necessarily access the cash value easily. In other words, one of the bells and whistles, one of the features of universal life is the fact that you can borrow against that money that sits in your cash value. Well, under guaranteed universal life, much more difficult to do so. There are additional reasons to be careful here when life insurance with living benefits, and that is that the benefits can be limited. So you can see the example here. If your death benefit is $100,000, you may only be able to bring forward $90,000 once you start activating it. Okay. Every carrier different here. On all of these points on this slide, every single point you can presume is going to be different. The amount of benefits you can receive in a period, that can be different. All of these moving parts move. Because of the way that life insurance works, there's no unifying way to compare apples to apples easily, or apples to pears easily, I should say. And for that reason, that's why I have the title More Extreme Caution Required, right? Since it's not systematically meaning the same thing, therefore it's more complicated, and therefore comparing apples to oranges, apples to pears is more complicated. By the way, I'm going to swerve again. This is why Medicare is so far in the buyer's favor. There's no doubt about what Part B deductible is. And under Medigap, apples, meaning Plan N, is apples at a different carrier, meaning Plan N, period, down to the comma, down to the last punctuation point. Punctuation point's not a word, is it? Anyway. Overall, here then is your trade-off. This is your trade-off on one slide here, if you will. Okay. And I know that the print is small, but so just focus on the blue inside there. Long-term care insurance is the red line. That's the premium you pay. You can see it's much more negative than the green line, meaning it's more costly. But in the instance that you require benefits, you can see the purple line. Far steeper payout to you, bigger benefits to the buyer, the consumer. That's you. Okay? So the maximum benefit amount, which is once the purple line flattens out, because there's a maximum amount you can receive, well, that is much higher than the brown line. So this, you can see it, the red line to the purple line, that's traditional long-term care. The green line to the brown line, that is life insurance with living benefits. We can go through all of these cautionary tales that I've told you about how to compare. My exercise in comparing is basically to show you this. What's the trade-off here in terms of what you have to pay and what you get? And this is Jay just following the cash flow. What are those situations? How much are you paying in advance? how much do you get if the situation requires that you get the benefits. Let's just go back here because I want to make this last point. So you can see what I'm saying when I talked about the overall plan, which is that for some people, the red line is just too expensive. Okay. Maybe then what you do is you have a smaller amount of benefit, but you still want the steepness of the angle. Some people say, well, Jay, red is still too expensive. Okay, that's okay. Then let's look at the green line. So in other words, if you had done what I'd said at the beginning, which you'd correctly defined what you're trying to get, how much you're trying to protect under what situation, and then you fit it to your resources as a household. Do you have that? You didn't hear me say, spend all the way to the red and don't eat. I'm never going to tell you that. Never. Right? And different households, the definition of that is differs. Of course it does. Some people have different priorities. Some people have different fears about having to pay the purple or having to want to receive the purple line. They've got a reason. That's a personal reason. That's not for me to determine. I don't get a vote here. I'm not asking for a vote. I'm here to tell you, to describe to you as clearly as I can exactly how the purple line works, how the brown line works, what are those situations in advance, so you know what you're that you know what you're going to get if the situation occurs. Now I'll stop here and go to the next topic. This is an annuity, and this is a fairly new twist as well, which is an annuity, which is explained in the video. You can see that the graphic there, that's the thumbnail. They're called thumbnails. Don't ask me why they're called thumbnails. Anyway, that's the thumbnail where I am describing annuities and what you need to know. Right? There's a separate YouTube video, and that's what the screen looks like. I'm going to presume that you actually know what an annuity is and that you know what lifetime income, guaranteed lifetime income is. There can be situations on deferred annuities that you hit the button and receive the guaranteed lifetime benefit rider. So you deposited 100, you waited for 7 years, you then annuitize, which is, the industry way of saying, I get my lifetime income number. And let's just call that X. Now there are annuities which you pay you X plus more. And let's call that Y. X, which is the guaranteed income amount. And then Y, this Y is a different and higher amount if you require confined care, for example, if you don't meet 2 activities of daily living. You'll need to see how this works out in writing. They will provide it to you. The sellers will provide it to you. Absolutely. So again, it does have to do with the same type of idea, trying to measure what does my purple or payout line look like as in this diagram. I'm doing the same thing here and informing you about this other type of product. You're going to get some income, and then there can be situations where that income increases from X to Y. Notable, very notable here is the information there in red. Is this type of policy has no underwriting. Unlike long-term care insurance, unlike life insurance, which both involve underwriting, which are probably going to be harder in the age of a pandemic. The annuity doesn't have underwriting. For some people, vital, right? Some people will not qualify for either long-term care insurance or for life insurance with the living benefits rider, but they can qualify here. That is possible. As anything, this type of product also has its own sets of pros and cons. The pros there are in any annuity, right? Which is that if you receive the lifetime income, if you've decided to annuitize, you've moved the longevity risk, your lifetime longevity risk, from yourself, where you were managing it, to the carrier. If you live to 200 years old, the carrier has to keep paying you X until you're 200. That's true. One way, and my way, right, which is going to be a common thread through all the videos, which is you got all this language. Okay, what's my accretion rate? What's my accumulation rate, et cetera, my annuitization rate? Yeah, I get it. But on every document, you'll see it. There's going to be a diagram. There's going to be an illustration there, which is going to show you how much money. So I tell persons, look, you're just trying to count cash. You're depositing 100 units on day one. How much am I getting later under that circumstance? Because how you got there, kind of matters. Maybe it's there to kind of attract you, to try to tell you, okay, here's how much your stuff is going to be worth. In other words, how steep it is. But ultimately, what you're trying to determine is you're trying to get the most lifetime income benefit, or your Y is the highest. In other words, you're counting cash at that point. That's how to compare all of these different policies. Okay? The cons there on your right-hand side of the screen. The negative here is that this does require a large deposit at the beginning. And for some people, I understand that is not attainable. But nevertheless, it is still important to go through that, right? Because you can remember from the beginning, go back to the beginning where I say define what you are doing, and then figure out what the cost would be, to see whether or not the benefits you get are vital and whether or not that fits in within your resource restraints. Right? Then and only after A and B are done, then you can then work out, okay, here's how much I can devote to it. And then you can then determine whether or not that path is worth it. Just like the life insurance, the last thing on the con side here on the right-hand side of your screen, which is, again, under this type of situation, many, many sellers, all creating different terminology that work slightly differently, but slightly differently in important ways. And I'm speaking slowly, intentionally, right? These are not standardized products, meaning that what someone else calls my guaranteed income and number is somebody else calls it something slightly different. Enhanced benefit guarantee, Jim Bob's income extra ultra plus, right? They're all using different terms, but we go back to the red on your screen here. Just count the cash. That can be your guide. So I'm almost done. And, you can see, like, almost all of my videos, and I understand that, we don't have a society that kind of like watches from beginning to end as a cohesive whole. It is a shortcoming of YouTube. It is a shortcoming of the way that we get information in our society, right? We want the answer. We want the answer quickly. We want it in 3 minutes so that we can go to the next video. Yeah, the problem here is that this is, as you can see through the complication of this topic, right, is that flushing out, going through and flipping over all the rocks in a comprehensive way has to be done kind of together in the same way, consistently. So while I understand there's going to be, 300 videos on this topic, that if you go and try to cherry pick, soundbite number 1 from videographer number 3, that's not going to be the same necessarily as my point. And while I'm not questioning whether or not that point from some other channel is right or wrong, let's just presume it's correct. What I'm saying is that by watching the entire video here, you get the cohesive whole about how to look through all of the different products so that you can compare them in a similar way, right? If you change your lens and then you change the product both at the same time, your vision is going to be off. That's the, kind of simplest way I can describe it. So anyway, we're back to my boring, and repetitive A, B, and C here. It's the same process for any single topic. Please define what you're trying to accomplish. You've got your own pressure points, your own pain points, your own sensitivity. What is it? Define it so that you can define how much resources out of your entire household net worth that you can allocate it. Maybe that's 0. Ultimately, maybe that's 0. And that's okay. Because you've watched until now and you decide, you know what? Given the way this, and now that I know it, and then you call me up and you say, okay, well, now what are actual prices? I tell you, and you say, okay, you know what? That's beyond reach. That's fine. At least then you have gone through the right steps and reached the logical conclusion. You can rest assured, okay, I've looked at it comprehensively. Please don't change the order of these steps. Don't change the order of these steps. Just to look at the sticker price. Because let's say, for example, and let's just take it here. Let's say I wanted the steepness of this purple, but I just couldn't, I just can't afford the full red. You could just lower the maximum benefit amount. In other words, the height of this purple. That would lower your premium. Maybe now you can find the fit. Maybe then you can find the fit that fits your budget, your resources, and addresses your objectives. That's the website, gh2benefits.com. That's kind of, so, unfortunately what happens is, I've written Maximize Your Medicare, and not that it's unfortunate, I wrote the book. What the unfortunate fact is that people think, okay, well, that's all this guy knows about. But the reality is that the common thread that I've used here, it basically hits all of these financial topics: financial planning, insurance, that can be to determining what employee benefits are offered to you and which ones you should take. And, there can be employee purchased benefits, whether or not that's worth it, et cetera, et cetera. That, and now these steps, this A, B, and C is going to look very similar. We're going to go through these same steps. We can change the topic. We can change the topic, as you can see on this slide. Process stays the same, in the same type of way. Practical, yet to try to get to objectives that you want to, garnish for the ones that you want to get. That's the contact information there, right? That's my email, phone numbers. You can have the first call for free, right? You can say, okay, Jay, here's my 5,000-foot view. If you need further individual topic analysis, that can occur. That's not the full suite. That means, okay, I'm looking at this particular topic. Can you analyze it? Can you look at Medicare? Can you look at my family's health insurance? Can you look at my employee benefits package? That is all possible. Please subscribe to the channel. If you like the video, please subscribe to the channel. There are going to be more videos. You're going to be able to see that this is much more than Medicare. I'm Jay. Thank you so much for watching. Hopefully you got something for today's video, learned something. If you have questions, comments, please place them in the space below the video. Speak with you next time.